Can I write this off? I can promise you this is probably going to be my favorite video. We'll see. Hey, I'm Peter Fider, CPA and founder of Meeple Accounting, where we help property management companies eliminate trust accounting risk through clean bookkeeping systems. If you're a business owner, you've probably asked that question a lot. And usually it's right after you bought something and you're really hoping that the answer is yes. And I get it. Everyone wants to save on taxes. I do. I love saving on taxes. But this is where people get themselves into trouble because they start guessing. And guessing leads to mixing business and personal, and that creates a mess. So here's the simple way to think about it. If it's ordinary and necessary for your business, it's a business expense. Plain English. Does this actually help you run your business? And is it normal for what you do? If yes, you're probably good. But where people mess this up is the gray area. Car. Let's start with the car. I'll use myself as an example. I have a personal property management LLC for my rental properties, and I bought a pickup truck, my beautiful Tundra. What I do is simple. I track my mileage in Excel. Every time I use it for business, going to a property, checking something, meeting someone, I log it. But if I'm driving my family around, that's personal. You can't just say, I bought a truck, it's a write-off. You're separating business versus personal use. There are two ways to handle it, the mileage method and the actual expenses, gas, maintenance, etc. Keep it simple, stay consistent, and if you're unsure, talk to your accountant or research it further. To be specific, here's what I'm going to tell you. When I have my Tundra, I also have another LLC, which is Meeple Accounting. It's actually called MB Fider LLC. Meeple Accounting is the fictitious name. So I'm not going to say that the Tundra is for Meeple Accounting. An accountant doesn't get a pickup truck. It doesn't. It's not normal. It's not an everyday thing, and the IRS will definitely question that. But again, I'm just kind of telling you, I specifically bought it for my property management, but of course, part of me is going to use it for personal use. But again, if you apply that expense to my Meeple Accounting, it's not going to work. That is going to be, or there's a good chance it's going to be flagged by the IRS. So, is it ordinary? Does it make sense? That's all I'm saying. The phone. Your phone is another easy one. If I use it 50% for business and 50% for personal, then only 50% of your phone bill is deductible. You're allocating based on the usage. Meals. Oh man, meals. This one gets abused a lot. If you're eating by yourself, probably not. I don't care how good the food is or was. But if you're meeting a client or discussing business, now it starts to qualify. General rule, most businesses' meals are about 50% deductible. It changed, by the way, in the 2026 rule sheet, so you just got to double check the rules. Home office, this is where it gets interesting. This has to be there has to be a dedicated space used regularly for business. You ever watch The Accountant? Great movie, by the way. There's a scene where an older couple needs help with taxes, and Ben Affleck walks through their house. He points out that the wife's jewelry business is being run out of a dedicated space and basically shows them they can take a larger deduction because of that setup. Now, let me be clear. We're not saying to lie. There's kind of like a lying there in the accountant. Don't make something a business space if it's not. What I'm saying is, if you really do have a dedicated space, use it correctly. For example, I have a section here in my basement, about a quarter of it, that is clearly separated and only used for business. There's no actual walls. That's what you want. But again, it's dedicated. There are different ways to calculate the deduction, simplified or actual, and there are limits depending on your situation. But the key is it has to be real. Vacation myth. Let me address something I know you've seen online. These tax gurus saying, take your family to Bora Bora or Key West, call it a board meeting, and write it off. That's not true. And I would strongly recommend not doing that. Because think about it. If that were actually a legitimate business expense, what would you need to prove it? You need things like documented meeting agendas, meeting notes, business purpose, time logs of actual work being done, who attended and why. And even then, you'd have to justify that the primary purpose of that trip was business, not vacation. If it's really a family vacation, then it's personal. Okay? Clear no section. Let's make this simple. Personal groceries, no. Family expenses, no. Like Netflix or whatever, that's not business expense. Random stuff you're hoping counts, probably not. Just because you want it to be a write off doesn't make it one. If you're unsure, ask yourself this: did I buy this because of my business, or would I have bought it anyway? If you would have bought it anyway, it's probably personal. And this is exactly why separating your business and personal accounts makes everything easier. I'll cover that in another video, but that's a big one: business and personal bank accounts or credit cards. At the end of the day, it's not about writing everything off, it's about getting it right. If this helps you and you want more simple breakdowns like this one, it would mean a lot to me if you like and subscribe. It really helps the channel. This is Peter Fider. Thank you for joining me today, and I'll see you on the next one.